There's been a relationship that's undeniable between the Fed's activity, not just the Fed funds rate, but also the quantitative easing and the bond buying. Mm-hmm. And the bond buying has every time supported equity markets. Weirdly, when they do bond buying, yields go up. A lot of people don't think that that should happen, but it has happened without exception. Mm-hmm. And so now that the Fed is really following the bond market per usual, they are forced to start to talk about raising interest rates more, talk about getting out of the quantitative easing business as early as March, which is pretty rapid. Now there's even talk of quantitative tightening has already started. We've gone from a completely dovish profile at the Fed with zero interest rates for years, with quantitative easing as far as the eye could see at 120 billion per month. And suddenly, when yields started to rise at the 2-year and the 5-year, the Fed always has to follow the bond market. Mm-hmm. So we now have today here, we have the highest 2-year yield of the past year. We have the highest 3-year yield. We have basically a tie on the 5-year yield. And so what's happening is the yield curve is sending a bona fide recessionary signal. You have interest rates going up at the short end and going down at the long end. That's the one investors really have to watch out for. It's one thing when the yield curve flattens because one end of the curve is anchored and the other one either goes down or this one goes up. But when they go like this, which is kind of a pivot, that's a very strong signal. It's not there yet, but it's starting to get into the territory where you have to follow it very, very closely. So with the Fed not doing quantitative easing starting March, well, the relationship between the size of the Fed's balance sheet and the market cap of the S&P 500 is what I call Gundlach's law of financial physics, mm-hmm. because it's worked so well. It did deviate a little bit during 2020 and 2021 a little bit because the action by the Fed was so aggressive. But that's what investors should worry about. The valuation of stocks is also worrisome in the United States. If you look at the CAPE ratio, Dr. Shiller's CAPE ratio.
One of my favorites.
And that is very elevated, nearly around 35 or so. If you look at the rest of the world, it's half of that. So the U.S. has been very, very strong. And we're at the point of kind of extremes where the valuation has been before, but it usually hasn't ended real well. And with the Fed in the reverse gear that they've been in for nearly 2 years now, mm-hmm. that's going to cause headwinds for investors, I think.
Do you think the Fed at some point raising interest rates this year, does that lead to an economic slowdown?
Absolutely. The bond market is already suggesting an economic slowdown is, I wouldn't exactly say on the horizon, but it's you can't just not think about it anymore like you could a year ago.